All right, let's put the stochastic RSI on our charts. And so if we go to indicators, we just type in stock and then stochastic RSI. All right, and so what is stochastic RSI? And so if we look at it mathematically first, we have this calculation that I have up here. And so stochastic RSI is solely using values from a regular RSI indicator. And so all it's taking is the current RSI and a certain amount of data points and figuring out what the lowest is between that time period, the highest is, and the lowest again, and just dividing them. And so all that really means is that the stochastic RSI, the real purpose behind it, is to increase the signal that we would normally see in the regular RSI. And so you can see that the stochastic is hitting the bottom and the top and then back to the bottom and the top a lot quicker than a normal RSI would for the same time frame. And so that's the sole purpose behind it, is to increase that kind of signal. And so with that, I'm actually going to remove the RSI from this chart so we don't actually have to look at it. And so now we just have our price action, our stochastic RSI, and that's it. That's all we're going to work with. First thing I like to do always is change the way these indicators look a little bit, and so let's go through here and we'll explain some of these things while we're at it. First thing, the blue background doesn't mean anything to me. Everybody's welcome to keep it. We're going to change this line from orange to red just to make it stand out a little bit more on our chart. Upper band, lower band I like to change to an actual color. That'll become more apparent probably a little bit later, and the middle band will make it a little bit brighter because these are really the important parts of this chart. All right, so now this is looking a little bit better. And so we have two lines on our stochastic RSI. One is labeled as K and one is labeled as D. The K line is the one that's actually doing this RSI calculation. So the blue line on this chart is the one that is actually the stochastic RSI. The D line, which is the red one shown down here, is actually the moving average of the stochastic RSI, and that's used kind of as a reference point. And so we can actually prove that if we go to the inputs, we have inputs for the K and the D. You don't have to worry about what this 3 is here, but this 3 for the D line is actually saying that it's using 3-point moving average. So the red line is the average of the last 3 data points on the blue line. And we can prove that by if we just change the D to 1, these two should overlap perfectly, which they do. And so as we move it out, it lags a little bit further. And the RSI length, the 14, this is using the amount of data points to check for the RSI. And so every data point on the stochastic is using 14. It's a 14-point average from the actual standard RSI. I'd recommend not changing these unless you have a real reason to do so, or are just solely messing around with things. This is going to be the very standard configuration for all stochastic RSI measurements. It's going to be pretty much the default what you should start with. So don't change them unless you have a real reason or calculation or method to do so. All right, so if we're getting into what this indicator actually shows us, or what people use it for to trade with, there's a few different ideas, and that's where each of these different lines come into play. One common misconception that I want to clear up is that a lot of people will use terms like overbought and oversold on RSI and stochastic RSI. And that's just bad nomenclature, because the two actually don't account for volume at all. They're just a momentum indicator. And so using words like overbought and oversold, I would just technically advise against, because they're just not technically correct. But what a lot of people use the stochastic for is to increase the amount of noise from the normal RSI, or increase the amount of signals. And so we showed before, like when we first started this video, that this has a lot larger swings than a standard RSI does. And so what that means is that your signals are amplified, but you end up with some more noise. And so what a lot of people use is essentially the pivot point idea, meaning that when this RSI gets really close to 0, so we can see this is sitting down here at 0, when it starts getting down into these ranges, it means that you can assume that a pivot is coming, because this means that there's been downward momentum for a long time, and you should now be getting a corrective swing higher. And so what that tends to mean for what a lot of people use is this lower line for it. So this line that's set down here at 20 is not necessarily saying, hey, buy at 0, but once this starts to exit this really negative momentum zone down here, so everything from 0 to 20, when it starts to exit that range, it's a sign of a little bit more strength. And so we can actually see that if I mark this, right where this is exiting that 20 range down here. Let me actually see if I can extend this. Extend, great. And I'll make that solid. And so right where it's exiting that 20 range, moving upward, we had a little bit of loss signal here, but by the time it gets to this top range, if you were to do the exact opposite, by the time it gets into this range where it's now saying, hey, we've been, momentum's been moving higher, now we're in this range above 80, that's a corrective idea to move back down. And so, somewhere, anywhere in this range, whether we entered the range up here, we exited the range over here, we can see that is, from this entry idea to that place where it exits that range is, almost around 20%. I mean, I can zoom in more on this. But that's a general idea, is that ranges underneath of this give ideas for corrections. Ranges above 80, or stochastic RSIs above 80, anything above 80 and exiting gives a downward momentum idea. Anything below 20 and moving out of that zone gives an upward idea. And again, this is all stuff that you can see on the RSI, it's just much smaller signals. And so this is the purpose of the stochastic. And of course, what you end up with is that there is some noise where this line did drop below that 80 line and comes back above it. A lot of people actually see that as a retest, which is what a lot of people would say, that this hits the strong momentum zone, bounces off that area and gets that bounce. And what we can actually see is right where that happens is actually the strongest move of this whole momentum swing here. And so that's just one general idea, and that idea just takes into account, look at the tops, look at the bottoms, look at the tops, look at the bottoms, and trade that range. And it's not always perfect because the stochastic does have a lot more noise in it than a standard RSI. But that's just one idea where you're not even accounting for the center line here. You're just looking at the corrective pivots. And I would say it's probably one of the most valuable strategies for the stochastic RSI. The other idea is accounting for this center line, and so 50. And so because it's 50, it's exactly the middle line. This indicator will never go below 0. It'll never go above 100. So 50 is dead center. And so what a lot of people will consider is that everything above 50 means you have positive momentum, which means that you're in an uptrend. Everything below 50 means that you have negative momentum, means that you're in a downtrend. So a lot of people actually, instead of using, what we just pointed at back here, where you're exiting this, pivot area as an entry, they'll actually use the 50 line for their ideas of going, or their ideas of trading long or trading short if it's over or under. And so the idea is that the more time that this indicator spends in the above 50 zone, the stronger the moves and the more strong the uptrend is. And so that's often true for, a lot of things like this where, this is more or less bouncing around the 50 zone, but the second this, in this whole range here where it's spent under the 50, kind of a little bit of chop that's happening over here. And the second it gets back above that positive 50%, upward momentum happening, very strong impulsive move upward. Of course, in this scenario, it didn't last very long, but that does show the relevance of that 50%, the top 50 and the lower 50. And that's even true for this example that we showed back here where, we had the exiting the lower band here, exiting the top band here, and most of this time is spent, above the 50. And so there's essentially the trading above the 50 or below the 50 for long or shorts just reduces the amount of essentially fake outs, the amount of false swings. So overall, there's a ton of different strategies to use for the stochastic RSI. everybody has a slightly different strategy on, how they want to weight these lines, if they actually want to, move some of these lines to different areas. And so, if you move this lower, you can increase or decrease your amount of kind of false signals and things like that. And so I would recommend kind of messing around with it and seeing what strategy, makes the most sense to each person, because everybody looks at these charts a little bit different. But just in general, if we were to go through and let's mark all the bottoms. And so we have bottom here, down here, here, here. Let me move this one. And so you'll notice that I'm marking all the ones where that blue line is moving back above the red line. And so we have all the bottoms marked there. And if we go through now and just mark some of the tops, and let me change the color on these. Let's just go to orange. So we have a top there. This one's, sorry about that. So top there, top here. I'm not going to mark that one because it's under the zone. We have a top out here, there's one in here, here, and we actually don't technically have another one yet. And so this is getting pretty noisy on the chart here, but what we can see is that, like, if we mark all of the bottoms at the light blues, in general, all of these entries till exits are all, let me change that color now, are all moving higher. And so we had our entry idea at the bottom here, moving higher. Entry idea here, a little drag down, and then a move higher still on the exit. Entry here, exit up top. Entry, exit. And so we have an entry here. Our RSI is not, it's not quite up there, but technically this is still, would be in profits at this point. And so this was just a really quick, very little data put into this, or on my end, based on just, here's the bottom, here's the bottom, here's the bottom. But you can see that, like, hitting those bottoms and tops is almost always a fail-proof method. And even all of these swings are, a lot of these are pretty significant at 20%, almost 30% on that. This one was an 18% drawdown before 25% gains. And so this is true for all of these. These are all relatively significant moves, even at 30%. And so it's certainly a worthwhile indicator to kind of mess around with. It's just super important to be conscious of the fact that the stochastic RSI is considered a volatile indicator. And so you will get a lot of, not necessarily false signals, but more so noise. And what I mean by that is that, even in this case where, this indicator comes down here and it spends some time here, this would normally look like the bottoming point here, but it's not. You have this next drawdown here. And if we look at the chart, that spot, that difference right there, is quite a significant drawdown. And so, just thinking that this was the bottom and entering on that, you would have ended up in, somewhere about 30-40% drawdown just based on the bottom. And so it's really important to remember that this scale is, it's a relative strength. And so when this indicator is down in its negative momentum zones and positive momentum zones, when it's up and above these ranges, the moves are the strongest. And so the fact that this bounced here and then pulled back down, the fact that this had a bounce in the negative area and then pulled back down in the negative strength, that was the very strong move that happened here. That's where all of that drawdown occurred. And that's true for a lot of these positive ranges too. This is another perfect example where you had this move here, which was, correlates to that curve here, and then this bounce. That's the strong one. And that's a big reason that a lot of people that use Stochastic RSI actually use entering and exiting the zones as their entries and exits. And so essentially when this gets above this range, it's not the sell idea yet. The sell idea actually occurs when it crosses back below. And so it takes me to kind of one last idea, sort of food for thought on how to trade with Stochastic RSI, is that a lot of people will, rely on these bands here. And so the 80 to 20 range for that exit entry idea. So it leaving the 20 is an idea for a long, or it extending past the 50 is an idea for the long. opposite for shorts. Other people actually use this moving average line. And so the reason that the moving average, which is the red line again, it's labeled as D if you open up the settings here. The reason a lot of people use that is because the 3-day indicator, what this means is that, down in this range, sorry, I keep hitting the wrong button. Down in this range, the very first signal you actually ever end up getting, it crosses the 20 right here on, was it May 28th at 8 p.m. It crosses above that 20 band there, but the actual first signal you get is the blue line crossing over the red way down here still. And so if you actually look at exactly where this is on the chart, you actually end up getting a lot more of that move if you do that in this case. And so you're actually able to use the 3-day average, because what that means is that for the last 3 days this has been down, and if the blue line goes above it, which is the actual stochastic RSI output, if that goes above it, that is an idea of a trend change. It's bouncing above the average. You're moving higher than the last 3 days. Of course, that's not always the case. That worked out very well in this scenario. There's times where back here that wouldn't have played to your favor. And so the reason for that is that, this is showing a much more premature signal that, hey, this is the first idea you get of that pivot point. And true for here too. This is that first idea of a pivot point for a short, or the market going lower. And so that just adds the idea that the stochastic RSI can have a lot of, false signals, a lot of premature signals. And so some final closing thoughts on stochastic RSI. It's a great indicator. It does show, it does highlight a lot of the main pivots a lot of the time. The one thing to be cautious of is that there's a lot of false signals, or that the big moves are actually happening when the stochastic RSI is either buried in the high strength zone or the low strength zone. And so I recommend, also jumping around to different time frames. The further you go into time frames, the more signals you'll get. You also get more noise. Of course, the opposite is true. If you zoom out a lot, the opposite happens, that you have larger swings that take more time to play out. But these are all the main ideas. I highly recommend, before just jumping onto a strategy for the stochastic RSI, that you backtest it. It's one of the best things about the stochastic RSI is you can backtest data as much as you want and see how it played out.